banks are which are higher in today's trade. But we do have the management of PTC India Financial Services with us, Mr. Ashok Haldia, the MD and CEO of the company. Mr. Haldia, hi, thanks very much for joining in. Well, let's start with growth prospects. You all are diversifying into the infrastructure sector, especially when it comes to roads and ports, and you already have renewable energy, which still constitutes at around, I think, 60% of your portfolio. So given all of these factors, how do you see growth panning out ahead?
For us, we have diversified into other areas for the reason that we wanted to be more risk prudent, diversified our portfolio, and to also position ourselves into other areas of economic infrastructure. Having said so, our strategy was to be highly prudent and the risk conscious when we enter into the new areas. So we ventured into the roads and the ports and also the logistic. In the roads, we adopted a highly calibrated approach only for the annuity and the HAM model and not on the toll. Similarly, for the ports, we opted for financing the existing ports going for the expansion. As far as the renewable is concerned, we are not going to reduce the focus. The only thing is that we are increasing our focus to other areas of the infrastructure. Having said so, any new project, maybe in the renewables or roads or ports or logistic, or any good promoter, they are welcome and we would be happy to fund them. If you are asking in terms of in the year to come, what would our portfolio would look like, I would believe about 20 to 25% should be the other areas, which might including the transmission. So I would believe the renewables should continue to be around 60%, and the other space would be for the other infrastructure.
Okay, fair enough. Mr. Haldia, there's been a decline in tariffs in renewable energy, especially when you talk about wind and solar. We have seen those tariffs declining. How do you see your yields pan out on those projects?
The concern is obvious, and so is of the lender. But we are looking at the project not only in terms of the tariff rates, but also in terms of the overall risk profile. The tariff rates are dependent upon the risk profile of the project and also of the promoter. If the project is adequately safeguarded for market risk, for the counterparty risk, for the infrastructure risk, then 244 or 254, the tariff rate for us is equally viable and equally good. And when such projects are coming to us, we are looking at the risk profile, to what extent the risks are mitigated, and to what extent the project has been ring-fenced for the possible increase in the cost of implementation till the project is implemented. So if a project has firmed up the supply contracts, the EPC contract, and the infrastructure arrangements, and the price is not expected to escalate, then we are funding those projects. As far as the impact on our yield is concerned, certainly there has been pressure on the yield because they are bidding at the lower rate, but at the same time the projects are less riskier than the earlier times. If you look at the projects coming in some of the zones, solar zones, you will find that the entire risk in terms of the land, the third party payments, and the transmissions, everything was fully safeguarded. Now in that scenario, if you are getting interest less by 50% of 50 basis points, I think it's worth it, and that to that extent reduce our risk.
Okay. Loan growth has actually come back to 16% in the quarter gone by, Q4 FY18. How do you see disbursements and assets under management to grow in FY19?
No, our growth would continue. The disbursement should increase by the same pace, and so also our portfolio. I've been maintaining that our portfolio should increase on year basis by about 25% at least. And seeing the pipeline that we have, seeing the potential that is taking place in the renewables and other infrastructure, I would believe that should not be difficult for us to achieve. And I am taking cognizance of the refinancing that is taking place in this sector.
Okay, fine. So asset under management could probably see around a 20% plus growth. But the one concern which actually came through was your gross NPA spiked in Q4 FY18, I think over 6% odd. What led to the spike, and how much do you probably expect to recover from it in FY19?
The reasons for the increase was with the coming of the 12th February circular. Some of the projects for which we were contemplating the OSDR, and those were under the consortium. Those projects could not proceed with the OSDR, and we had to classify them as the NPA, and we are dealing with those assets as such. In terms of the scenario that might unfold on the NPA, out of this 850 odd crores NPA, we have about 550 crore of NPA which are at various stages of reference to the conclusion before the NCLT. One of the case that finally resolved and is pending approval of the NCLT is for more than 3 to 4 months. Now, as soon as that resolution is approved by the NCLT, to that extent the NPA would reduce, and then we have the other cases which are in the pipeline for the NCLT. In addition, we have about 260 crores of the projects which are at various stages of resolutions through the ARC mechanism, and that we would expect that in the coming quarters we should be able to get that resolved, provided we do not face much other legal problems before the NCLT or otherwise.
Okay, Mr. Haldia, before we let you go, just a quick last question. Speaking about the RBI's 12th Feb circular, how do you see the formation of an AMC for stressed assets in the power sector actually helping in reducing stress for power financiers?
The concept of AMC has been long advocated, and this would help in holding the assets till their economic value increases, considering the improvement taking place in the sector. If the demand improves and the coal linkages and the wagon supply improves, in that scenario certainly the economic valuation of these assets would improve. If you look at a trend that has been taking place in the last 1 year or in the other sector, there has been gradual increase in the economic value of these assets. So if you are able to hold back these assets and then manage them and operate them till the economic value of those assets increases, certainly it would help the banks and the financial institution to a great extent. And I am sure the quantum of it that the banks are expected, or the financial institutions are expected to take today, should reduce considerably.
Okay, all right, Mr. Haldia, we're going to let you go on that note. Thanks very much for joining in and speaking with us. So that is PTC India Financial Limited. But my co-anchor has joined me after interviewing the telecom secretary, and I think there are some exclusive details on Idea which are flashing as well.
Yeah, I mean, so a lot of the conversation, and we cut to a bit of it earlier, was about the policy and net neutrality and investments in the sector, government's policy priorities. But this is a deal-specific flash. So